There's a bubble in America right now that makes the 2008 housing crisis look like a rounding error. It's larger than the dot-com bubble, larger than the cryptomania, larger than every stock market bubble in American history combined. And here's what makes it truly terrifying. This bubble wasn't created by Wall Street traders or Silicon Valley speculators. It was engineered deliberately, brick by brick, across 5 decades inside the halls of Congress, the Federal Reserve, and the Treasury Department. This is the dollar bubble, and it's not hiding in markets. It's embedded in the laws, budgets, and institutions of the United States government itself. The largest financial bubble in human history was built inside Washington, inflated by Washington, and can only be detonated by Washington. Every bubble in history follows the same pattern: euphoria, expansion, dependency, then collapse. But this bubble is different in one critical way. When tech stocks crashed in 2000, the government survived. When housing collapsed in 2008, the government survived. When this bubble bursts, the government doesn't survive. Not in its current form, because this time the government isn't trying to contain the bubble. The government is the bubble. Let me show you exactly how Washington engineered the most dangerous financial weapon in American history, why the people at the top positioned themselves years ago, and why what's coming isn't a prediction, it's mathematics. Every bubble begins with a new paradigm, a moment when the old rules are thrown out and replaced with something that seems brilliant at the time. For the dollar bubble, that moment came on August 15th, 1971. President Richard Nixon appeared on television and announced that the United States would no longer convert dollars to gold. This ended the Bretton Woods system, the framework that had governed global finance since 1944. And in that single decision, Washington discovered something extraordinary. They could print money without limit. Before 1971, the dollar was tethered to gold at $35 per ounce. This created a hard constraint. If the government spent too much, other nations could demand gold in exchange for their dollars. It was a check on power. It forced fiscal discipline, but Nixon severed that chain. And once the dollar was no longer backed by anything except the full faith and credit of the US government, Washington learned they could spend without immediate consequences. The 1970s were chaotic. Inflation surged. Oil shocks devastated the economy. But something else happened that would prove far more significant. Congress discovered that deficit spending had become politically costless. They could promise benefits to voters, fund programs, and finance it all by borrowing. The deficits were small at first, $50 billion or $70 billion annually, but the pattern was set. What Washington learned in the 1970s was this: deficit spending is the ultimate political drug. It allows you to deliver benefits today and push the costs to the future. You get the votes now, someone else deals with the bill later. This wasn't an accident, it was a structural incentive that would drive every decision for the next 50 years. By 1981, the national debt had grown to $900 billion, and that sounds almost quaint now, but it represented the first stage of the bubble, the moment when deficit spending transitioned from emergency measure to permanent policy. Washington had weaponized the printing press. They just didn't realize they were building a bomb. Stage 2 is when the bubble starts feeding itself, when the system that was supposed to be temporary becomes permanent, and when the people who understand the game start positioning themselves to profit. In the 1980s, something remarkable happened. The US government debt became an asset class. Treasury bonds became the safest, most liquid financial instrument in the world. Central banks bought them, pension funds bought them, insurance companies bought them. Japan and China accumulated trillions. US government debt became the foundation of global finance. This created something unprecedented, a self-reinforcing cycle. The more debt Washington issued, the more essential it became to the global financial system. And the more essential it became, the easier it was for Washington to issue more. This is the core mechanism of the bubble. Debt isn't a burden, it's the product. Reagan entered office in 1981 promising to balance the budget. By the time he left in 1989, the national debt had tripled to $2.7 trillion. But something else happened. Interest rates, which had been over 15% in the early 1980s, began falling. Lower rates meant Washington could borrow more for less. The debt grew, but the cost of servicing it remained manageable. This was the seduction. As long as rates stayed low, the bubble could expand indefinitely. Congress spent. The Fed kept rates low. Treasury issued bonds. Foreign nations bought them. The cycle continued, and everyone involved convinced themselves this was normal. By 2001, the national debt reached $5.8 trillion. Deficits had become structural. Not emergency responses to crisis, but permanent fixtures of the federal budget. Republicans spent. Democrats spent. It didn't matter who was in power. The bubble required expansion, and Washington delivered. What's critical to understand about Stage 2 is this: the people at the top knew exactly what was happening. Wall Street banks that underwrote Treasury auctions made billions in fees. Defense contractors that received government spending made fortunes. Political donors who benefited from subsidies and tax breaks were inside the system. The bubble wasn't a mistake, it was designed. And the people who designed it positioned themselves to profit from its growth. Every bubble needs a catalyst, a moment when caution gets thrown out completely. For the dollar bubble, that moment was September 11th, 2001. The terrorist attacks gave Washington something they'd never had before, a blank check justified by national security. Defense spending exploded, not just for immediate military operations, but for a permanent expansion of the national security state. Iraq, Afghanistan, Homeland Security, intelligence agencies, the wars that were supposed to be temporary became permanent. But here's what nobody talks about. The war on terror wasn't just about security. It was about embedding deficit spending so deeply into the American system that questioning it became unpatriotic. If you opposed spending $2 trillion on wars, you were undermining the troops. If you questioned the expansion of DHS, TSA, and surveillance, you were soft on terrorism. The bubble wrapped itself in the flag. By 2008, the national debt reached 10 trillion. It had nearly doubled in 7 years. But that was just the beginning, because in September 2008, the financial crisis hit, and Washington learned something that would change everything. They learned that the bubble was too big to fail. When Lehman Brothers collapsed, when AIG teetered, when the global financial system was hours from complete breakdown, the US government stepped in with a response that was previously unimaginable. $700 billion for TARP, trillions more from the Federal Reserve and emergency lending. The Fed's balance sheet exploded from $800 billion to $2.2 trillion in months. And here's the key insight. This wasn't a bailout of banks. It was a bailout of the bubble itself. Because if the financial system collapsed, who would buy treasury bonds? If foreign central banks lost faith, who would finance the deficit? The 2008 crisis proved that the US government had become dependent on an ever-expanding financial system to absorb its debt. They couldn't let it fail because failure would mean they couldn't borrow. This was stage 3, the moment when emergency measures became permanent policy, when trillion-dollar deficits transitioned from crisis response to normal, when the Federal Reserve learned it could print trillions to buy government bonds and the world would accept it. The bubble had metastasized from a political problem to a systemic dependency. After 2008, something changed fundamentally. The government stopped even pretending to pursue fiscal discipline. The deficit became a feature, not a bug, and the Federal Reserve became the enabler that made it all possible. Quantitative easing, that's what they called it. The Fed printed money to buy treasury bonds and mortgage-backed securities. $3.5 trillion between 2008 and 2014. The stated goal was to stimulate the economy, lower interest rates, and encourage lending. But the real effect was far more significant. It allowed the US government to borrow trillions while keeping interest costs near zero. Here's how the mechanism works. Treasury issues bonds. The Fed prints money and buys them. The government spends the money. The deficit grows, but because the Fed is buying bonds, interest rates stay artificially low. This allows Treasury to issue more bonds. The Fed buys more. The cycle continues. It's not capitalism, it's not even socialism. It's a closed loop between two branches of the same system, printing money to finance itself. Between 2008 and 2020, the national debt doubled again from $10 trillion to $20 trillion. But because interest rates were pinned near zero by Fed policy, the interest payments remained manageable. In 2019, the US paid about $375 billion in interest on $22 trillion of debt. That's an effective rate of roughly 1.7%, historically unprecedented. This created a dangerous illusion. Politicians looked at the interest payments and concluded debt didn't matter. Modern monetary theory became fashionable in progressive circles, arguing that a government that prints its own currency can never default. What they didn't say is that you can't default if you destroy the currency's value. You just pay back debt with worthless money. By 2020, the bubble had reached a new level. The government was running trillion-dollar deficits during an economic expansion. Not during recession, during growth. Tax cuts passed without spending cuts. Spending increases passed without tax increases. Both parties agreed that deficits didn't matter because the Fed would always be there to buy bonds and keep rates low. But here's what nobody in Washington wanted to admit. The system had become addicted. The government needed deficit spending to function. The Fed needed to print money to finance the government. Wall Street needed the Fed to keep asset prices inflated. Everyone was dependent on the bubble continuing to expand. Stopping meant collapse. So it continued. This was stage 4, the addiction phase, when the bubble becomes so embedded in the system that removing it would destroy everything. When the people running the system understand this and decide the only option is to keep inflating. When the mathematics become irreversible, but everyone pretends it's sustainable. March 2020. COVID-19 hit, and Washington did something that would have been unthinkable just a decade earlier. They printed more money in 2 years than in the previous century combined. The CARES Act, $2.2 trillion, Paycheck Protection Program, 800 billion stimulus checks, enhanced unemployment, Federal Reserve intervention on a scale that dwarfed 2008. The Fed's balance sheet exploded from $4.2 trillion to $9 trillion, nearly $5 trillion printed in 18 months. The national debt went from $23 trillion in early 2020 to over $31 trillion by the end of 2022, an increase of $8 trillion. That's more than the entire national debt in 2006 in 2 years. And here's what's critical. This wasn't just emergency spending. It revealed that the government had crossed a threshold. They proved they could print trillions instantly with minimal political resistance. They proved that the Fed would finance any level of spending. They proved that deficit spending had no upper limit as long as the currency remained accepted. But something else happened: inflation. After a decade of money printing that produced only asset price inflation, consumer price inflation returned with a vengeance. By 2022, CPI hit 9%, the highest rate since the early 1980s. The dollar lost roughly 20% of its purchasing power in 2 years. This was the moment the bubble began showing cracks. Because inflation does something that low rates and asset bubbles don't. It affects everyone. Voters notice when groceries cost 20% more, when gas doubles, when rent surges. Inflation makes the bubble visible. The Fed responded the only way it could. They raised interest rates aggressively from near 0% to over 5% in 18 months, the fastest rate increase since the 1980s. And this is where the mathematics become inescapable. The U.S. national debt is now $36 trillion, and the interest rate on new borrowing has gone from near 0 to 5%. This means something catastrophic. The interest payments on the national debt are exploding. In 2020, the U.S. paid about $345 billion in interest on $27 trillion of debt, an effective rate around 1.3%. In 2024, the U.S. is paying over $1 trillion in interest on $36 trillion of debt, an effective rate approaching 3%, and climbing as old, low-rate bonds mature and get replaced with new, high-rate bonds. Let me make this clear. The United States government is now spending more on interest payments than on national defense, more than Medicaid, more than all discretionary spending except Social Security. And this is with only a portion of the debt refinanced at higher rates. As more bonds mature over the next decade, the interest burden will consume an ever larger share of the federal budget. This is stage 5, the point of no return. The moment when the mathematics become irreversible, when the debt is so large and rates are high enough that interest payments begin crowding out all other spending. When the only options are default, hyperinflation, or financial repression. And default isn't an option for a reserve currency. Late-stage bubbles have a tell. The smart money exits before the crowd. And right now, if you know where to look, you can see the elite repositioning. Central banks globally are buying gold at the fastest pace since the 1970s. China's official gold reserves have increased by over 60% since 2018, but unofficial estimates based on import data suggest China has accumulated far more than they report publicly. Russia, after being cut off from dollar reserves through sanctions, liquidated nearly all its U.S. Treasury holdings and bought gold. Turkey, India, Poland, Singapore, dozens of nations are diversifying away from pure dollar reserves. This isn't random. This is positioning. Central banks don't buy thousands of tons of gold because they're worried about inflation next quarter. They buy gold because they see the long-term trajectory of the dollar and understand what's coming. Saudi Arabia, the cornerstone of the petrodollar system since 1974, began accepting yuan for oil sales to China in 2023. This breaks a 50-year agreement that cemented the dollar as the global energy currency. It's not an economic decision, it's a strategic hedge. The Saudis see the same pattern everyone else sees: endless deficits, political paralysis, and a currency that's being debased. Wall Street is positioning too, but quietly. BlackRock, the world's largest asset manager, has been vocal about inflation being structural, not transitory. They've shifted allocations toward hard assets, commodities, and inflation-protected securities. Jamie Dimon, CEO of JP Morgan, has warned repeatedly about a coming fiscal crisis. These aren't public service announcements, these are signals to clients. Reposition now. Even inside Washington, the positioning is visible. Members of Congress who have access to economic briefings the public never sees show unusual trading patterns: stock sales before crashes, purchases in defense, and commodity stocks before geopolitical events. They're not predicting, they're informed, and they're acting on that information. This is stage 6, the elite exodus, the quiet diversification, the moment when the people who understand the system start hedging against it. They're not running for the exits yet, that would cause panic, but they're moving toward the door, slowly, methodically. Before the crowd realizes what's happening, every bubble requires a trigger, the moment when the expansion stops and the collapse begins. For the dollar bubble, the trigger won't be a market crash, it will be a failed treasury auction. Here's how the end begins. Treasury holds auctions regularly to sell new bonds and roll over maturing debt. For decades, these auctions were oversubscribed, more buyers than bonds. But as confidence erodes, as inflation persists, as interest rates rise, demand weakens. At some point, possibly in the next 5 to 10 years, maybe sooner, an auction fails. Not enough buyers. The remaining buyers demand higher yields to compensate for risk. Yields spike. And this creates a doom loop. Higher yields mean higher interest costs on new debt. Higher interest costs mean larger deficits. Larger deficits mean more bonds to sell. More bonds mean lower prices and higher yields. The cycle accelerates. The Federal Reserve faces an impossible choice. Let yields spike, which causes interest payments to explode and potentially triggers defaults across the economy, or print money to buy the bonds themselves, which is direct monetary financing of deficits, hyperinflationary, and destroys confidence in the currency. If they choose to print, the dollar's value collapses internationally. Foreign holders of treasuries dump them. Inflation surges domestically. The purchasing power of every dollar held by American citizens evaporates. Savings, pensions, wages all lose value simultaneously. If they choose not to print, interest rates surge. The housing market collapses. Stock markets crash. Corporations that relied on cheap debt to finance operations go bankrupt. State and local governments that borrowed heavily face insolvency. The economy enters a depression worse than 2008 because this time the government can't bail anyone out. They can't even borrow to fund basic operations. This is stage 7, the trigger point, the moment when the mathematics overwhelm the politics, when Washington discovers that the bubble they engineered is now beyond their control, when the debt becomes unpayable, the interest becomes unserviceable, and the choices narrow to various forms of collapse. What makes this different from previous debt crises is scale and integration. When Argentina defaulted in 2001, it was regional. When Greece nearly collapsed in 2012, the EU contained it. But when the United States hits this point, there's no backstop. The dollar is the global reserve currency. U.S. treasuries are the foundation of the international financial system. A U.S. debt crisis is a global systemic crisis. Let me show you why this isn't speculation, it's arithmetic. The U.S. national debt is $36 trillion and growing by $2 trillion per year. At current interest rates, around 3% average, that's over $1 trillion in annual interest payments. But here's the key. Most of the debt is still priced at the old low rates. As bonds mature and get refinanced at current rates, the interest burden climbs. If the average interest rate on the debt rises to just 4%, annual interest payments hit $1.4 trillion. At 5%, it's $1.8 trillion. At 6%, it's $2.1 trillion. For context, total federal tax revenue in 2023 was about $4.4 trillion. If interest rates normalize to historical averages around 5 or 6%, interest payments alone would consume 40% of all federal revenue. That leaves 60% for everything else: defense, Social Security, Medicare, Medicaid, everything. And the deficits keep growing because interest costs are now a major driver of the deficit. You borrow to pay interest on previous borrowing. This is the endgame of every debt bubble. Self-reinforcing acceleration toward mathematical collapse. The Congressional Budget Office's own projections show debt reaching 180% of GDP by 2050. And that's assuming no recessions, no wars, no crises. It's a best case scenario. And even in that scenario, the trajectory is unsustainable. But the real timeline is almost certainly shorter because projections assume the current system continues. They assume buyers keep showing up to treasury auctions. They assume the dollar maintains reserve status. They assume inflation remains moderate. Remove any of those assumptions and the timeline compresses dramatically. When reserve currencies collapse, when debt bubbles pop, when governments lose the ability to finance themselves, ordinary people bear the cost, not the elite who positioned early. not the politicians who inflated the bubble, the citizens who held the currency. Weimar Germany in the 19th and 20s saw savings wiped out by hyperinflation. A lifetime of work became worthless. Zimbabwe in the 2000s saw the same. Venezuela in the 2010s saw it. It's not ancient history, it's recurring history. And it happens when governments become dependent on printing money. The United States won't experience Weimar style hyperinflation where you need a wheelbarrow of cash for bread. It will be more sophisticated, more controlled. Financial repression through negative real interest rates, inflation that runs higher than the yield on savings. Your money loses value slowly rather than instantly, but it still loses value. If you hold dollars, dollar denominated bonds, dollar based pensions, you are exposed. If you have fixed income investments that aren't inflation protected, you're exposed. If you think the government will make your Social Security and Medicare payments in dollars that buy the same amount in 20 years, you're assuming the bubble doesn't pop. You're assuming Washington solves a mathematical problem they've been making worse for 50 years. The smart money understands this. They're diversifying into assets that hold value regardless of currency. Real estate, productive businesses, commodities. Some are even buying gold, not because they're predicting apocalypse, because they're reading the mathematics. Let me show you something that should make this undeniable. History is filled with governments that tried to print their way out of debt crises. The Roman Empire debased its currency. The French monarchy financed deficits by printing assignats. The Confederate States printed to finance the Civil War. Every government that chose monetary expansion over fiscal discipline faced the same end: currency collapse. The United States has something previous empires didn't. The dollar is the global reserve currency. This buys time. It allows the bubble to grow larger than would be possible otherwise, but it doesn't change the mathematics. It just delays them and makes the eventual collapse more catastrophic because the scale is so much larger. From 1971 to today, Washington has been on a single trajectory: larger deficits, more debt, lower rates, more printing. Each crisis led to more intervention. Each intervention created dependency on the next. And now we're at a point where the system can't function without continuous expansion. The pattern is clear. Stage 1, weaponize deficit spending. Stage 2, financialize the debt. Stage 3, make emergency spending permanent. Stage 4, become addicted to money printing. Stage 5, reach the point of no return. Stage 6, elite exodus and diversification. Stage 7, the trigger when Washington can't borrow. We're between stage 6 and 7 right now. The signs are everywhere. Falling dollar reserve share, central banks buying gold, rising interest costs, political paralysis, and most importantly, the mathematics showing that the current path is unsustainable. Here's what people misunderstand about financial collapses. They don't happen overnight, they happen slowly, then all at once. The tech bubble peaked in 2000, but many stocks had been falling for months. The housing bubble peaked in 2006, but foreclosures started earlier. The signs are always visible to those who know where to look. The dollar bubble is collapsing right now. It's just collapsing slowly. The dollar's share of global reserves has fallen from 72% in 2000 to 58% in 2024. That's a 14 percentage point decline, representing trillions shifted out of dollars. It's happening gradually enough that most people don't notice, but it's happening. Inflation from 2021 to 2023 erased roughly 20% of the dollar's domestic purchasing power. That's not coming back. The interest payments on national debt are now over $1 trillion annually and rising. That's not reversible without defaulting or inflating. The political system has shown zero ability to reduce deficits. That's not changing. These aren't predictions. These are facts happening right now. The collapse isn't coming. The collapse is in progress. We're just in the early stages where it's gradual, but every bubble reaches a point where gradual becomes sudden, where the slow leak becomes a rupture, and the mathematics say we're approaching that point. If you want to know when this accelerates, watch 3 indicators. First, watch Treasury auction results. If demand weakens, if yields spike unexpectedly, that's the signal the endgame is starting. Second, watch the Fed's balance sheet. If they start expanding again while inflation is still elevated, that means they've chosen to print rather than let rates rise. That's hyperinflation risk. Third, watch dollar reserve data. If the decline accelerates from 1% per year to 3% or 5% per year, that's the confidence crisis. The most likely timeline? The trigger point, the failed auction, or the confidence break happens within 5 to 10 years. Maybe sooner if there's a geopolitical shock or financial crisis. Maybe later if the Fed can somehow thread an impossible needle. But the mathematical trajectory makes it almost certain this decade or early next. And when it happens, the transition will be fast. Not years, months. Because modern financial markets move at the speed of electronic trading. When confidence breaks, when the sell orders hit, When central banks dump treasuries, it cascades within days. The people who understand this are positioning now, not in panic, methodically, because they know the pattern. They've read the history, they've done the mathematics, and they know that the largest financial bubble in American history wasn't created by Wall Street traders gambling with derivatives. It was engineered inside Washington by politicians spending money they didn't have, financed by a central bank printing money to enable them, backed by a global reserve currency that's losing its status. This is the dollar bubble nobody sees because it's not in stock prices or home values. It's in the laws, budgets, and monetary policy of the United States government. It's in the $36 trillion national debt. It's in the $1 trillion deficits. It's in the Federal Reserve's $9 trillion balance sheet. It's in the interest payments that are about to consume the federal budget. And when it pops, when stage 7 arrives, when Washington discovers they can't borrow to finance basic operations, the crisis won't start on Wall Street. It will start in Washington, in the Treasury Department, in congressional budget negotiations, in Federal Reserve emergency meetings. The next collapse starts in Washington because the bubble was built in Washington, and the fuse is already lit. The only question is whether you see it before everyone else does, or whether you're the liquidity that transfers wealth to those who positioned first. The pattern is clear. The mathematics are inevitable. The timeline is accelerating, and the dollar bubble that nobody sees is the only bubble that matters, because when it pops, everything else goes with it.